Hello, welcome to Investor Insights. I'm Chloe Cho. In a week filled with huge risk events, there is a lot at stake for investors, especially with U.S. earnings getting into high gear and global equities at 8-month highs. Here's a look at our headlines.
While helicopter money may not be in the works, the Bank of Japan is under intense pressure to meet heightened market expectations to ease. How much is priced in? Despite Italian government rejections of systemic problems among local banks and a bail-in of private investors, steep falls in Monte dei Paschi shares reveal the extent of investor jitters ahead of the release of key stress test results this week. Plus, Trading Talents Asia Pacific unveils top 4 who will go on to compete in the region's first televised trading challenge. Let's get insights from Richard Yetsenga, Chief Economist of ANZ. And our judges of Trading Talents Asia Pacific, Kay Van Peterson, Global Macro Strategist, Saxo Bank Group, and Jerry Raper, founder, Raper Capital Management. It's a big week for central banks with meetings by both the Fed and the Bank of Japan. Futures prices imply expectations of the status quo for the U.S. Central Bank until March 2017, while a Reuters poll predicts a move in the fourth quarter of this year. Of keen market interest will be any clues about the Fed's policy trajectory. The U.S. dollar and government bond yields have perked up in recent weeks post-Brexit, with the dollar index sitting below a 4-month high. 10-year Treasury yields have also climbed steadily since touching a record low of 1.32% on July 6th. While helicopter money is being set aside in Japan, the Bank of Japan is seen adding more stimulus between 10 trillion and 20 trillion yen, stepping up ETF purchases and even cutting interest rates further into negative territory amid stagnant growth and deflationary risks. The yen has fallen in anticipation, and much like the Fed, key will be what BOJ Governor Haruhiko Kuroda will say about the prospects of fiscal stimulus.
Do all of the expectations explain why fund flows have returned to Asia this year? And will they remain that way? Let's talk more with Richard Yetsenga, Chief Economist of ANZ. Welcome. So a lot of nervous tension reverberating around this BOJ decision on Friday. But will a mildly hawkish Fed somehow counterbalance that and actually keep things more or less the status quo for EM, Asia, Japan?
Look, I think probably. I mean, the Fed, as you suggest, probably will be mildly hawkish. I think the difference this year is the Fed's, well, when we talk about the Fed, actually, it's hard to know who we're talking about. Let's talk about, the Fed leadership, really, the 3 most important people. They seem to have had a bit of a change of heart this year where they are much more sensitive to global conditions. So in a sense, they seem to want to be a bit behind the market rather than a bit ahead of the market. They don't want to be a driver of volatility. So I think that means if the Fed is a bit more hawkish, it's likely to be in a kind of a more settled global environment, which is what we've seen, even with Brexit, of course. It's funny to describe the global environment as settled, but even with Brexit, actually, the ripples have been narrowly based in a couple of asset markets and not actually particularly broad.
Last week, our guest was telling us that what Japan might do would be a huge game changer in terms of fund flows for the next 3 to 6 months. If they disappoint, given the hyped up expectation, is it still a game changer?
Look, I think capital's leaving Japan, there's no doubt about that. Foreign capital is not looking at Japan as a particular investment destination. I struggle to see how a new style of fiscal policy in Japan really changes either of those dynamics.
Well, if they're money handouts, cash handouts, and it helps the banks, it helps dollar-yen trade, no?
Look, probably it does help dollar-yen go up a bit, but at the end of the day, the Fed's probably still in, a slow, gradual, but medium-term tightening track. And it's hard to see how that really kind of outweighs the force of the Fed going only very slowly over a long period of time.
That means that we're back to the notion of divergence, and does this sort of sweet spot for EMs, Asia, continue?
Look, I think it does, as well as the Fed being a bit more cautious. I think the other piece of the puzzle is in 2014 and 2015, Asia had quite a steep export slowdown, and no question there are structural issues there, but I think that kind of cyclical mini export collapse, that's definitely behind us now. The data's clearly saying that. So slightly more cautious Fed, slightly better trade kind of picture, I think leaves Asia in a reasonable position.
What about China? The impact of China is still slowing steadily, but still slowing. And you also have this increasing dynamic between the renminbi weakening and the Japanese yen, not so much all about the dollar.
Look, absolutely, this regional dynamic is important, and that's probably also one of the things which has encouraged the Fed to be a bit more cautious. If they are too hawkish and they weaken the renminbi a lot, it tends to add regional instability. But I think a bit of renminbi depreciation of a gradual nature, I think, you know, regional asset markets can absorb that. And as you say, China is slowing, but gradually and modestly over time. And I think that's also kind of adjustable for the region as well.
Then, if we're back to the notion of divergence, is it possible that ultimately we could be looking at a regime change? We're talking about reflationary. We started from quantitative easing and then this deflationary fear, and then bond yields started spiking lower, started skidding lower and lower, and then all of a sudden reflationary trades could pick up momentum.
Look, I think outside bond markets, you've definitely been seeing that. In the last 6 to 9 months, commodity markets largely have finished their bear markets, and there's been a lot of this going on. Kind of risky currencies in the commodity space and in the EM space have been much more stable and done a bit better. Even the Brazilian real, where the economy there still looks to be in recession, the currency started to do a bit better. So I think you're definitely seeing that. The puzzle, of course, is why bond yields globally just keep heading lower. And that's the piece which looks like, you know, there's still some major structural issues in the global economy we have to deal with.
Maybe we could get some hints from the European banking system. We've got stress tests
Look, the
coming
stress
up.
tests the stress tests are important, I think, as a signal about where Europe is. As a market signal, they've probably been outweighed by a very stimulatory policy setting from the ECB, but as a signal about Europe's structural reform, the way Europe tackles the banks is really important.
Well, we'll talk more about the risks, systemic risks from the European banking sector when we come right back with Kay Van Peterson and Richard Yetsenga. But first, we're going to head out to Trading Talents Asia Pacific. Remember, top 6 becomes top 4 this week. Stay tuned. Welcome back. It is time for Trading Talents Asia Pacific, the region's first televised trading challenge. We are just 1 week away from the grand finale, and let's find out how our top 6 stacked up.
Trading Talents Asia Pacific is at the cusp of unveiling top 4 who will participate in the finale next week. The journey began 5 weeks ago with 20 finalists who emerged from more than 2,000 other trading enthusiasts through 4 qualifying rounds. As the region's first televised trading challenge comes down to the wire, the penultimate week saw Wall Street ending at a new high, the US dollar gaining momentum, global equities at 8-month highs, while oil prices began coming off.
Actually, I went along for the oil. So happens that when the US the bakery oil rig count result came out, actually market came off a lot. So actually, I was out of the money for about $1,000. But I managed to take a cut at $600, which is I'm quite happy about it.
The strategy has actually changed from what I started off with. I started off taking smaller positions for a longer horizon, but now I'm mostly day trading, restricting myself to day trading.
With just 1 week to go, every trade counts ahead of key risk events in the US, Japan, and Europe that could make or break their chances of clinching the grand prize of $30,000 US and another $10,000 for the runner-up. 2 finalists are eliminated this week based on the judging criteria of net portfolio value, max drawdown, judges' scores, and clout score. Plus, 5 online voters voting for their favorite trading talent get to win $100 worth of e-vouchers this week.
Your ego tends to be your biggest enemy, and that's also why you find people who have a more systematic, programming, black box strategy tend to cover that ground well.
It's imperative that you have a framework where you harness those emotions.
You have the edge or the right information on an individual stock or sort of a smaller idea. A global force can come along and knock that right through.
Risk management is one of the most important things in being a successful investor.
We're going to unveil top 4, those who will take part in the grand finale next week momentarily. But first, let's find out what some of the winning strategies were with Kayvan Peterson, macro strategist, global macro strategist of Saxo Bank Group, and Jeremy Raper, founder of Raper Capital Management. In the leadership, guys who are making very, very tight risk management and keeping tight stop losses. And it looks like they're starting to come through.
We were discussing this with Jeremy early on. It's interesting that you see the people who are left. First of all, a lot of them had either won one of the previous kind of weeks, but also they've been in the business for a while.
Right.
Which we were
all
kind
the
of,
newbies are out.
Yeah, and we were kind of like, phew, because if it was just someone that kind of is a first week trading and they'd never looked at it before, then we'd probably be questioning our career choices in essence.
Validation point,
right.
yeah.
So I think that's a serious takeaway here. You can't just kind of walk off the street and even in just a few weeks have consistent back-to-back returns that are positive and good. And also, we were also making sure that if you only traded a few, so statistically, you need at least 20 trades to see whether you actually really consistently worse or better, right? And all of these people did that, right?
Yeah, what's interesting is we just heard from Richard and Rahul. Rahul keeps on talking about how he's gone from changing his mindset from a long-term, medium-term investor to a day trader, and that significantly improved his performance. On the other hand, you had Richard saying he lost a little bit on gold futures, because he thought gold would rise, but he went long, but in the end, he managed to cut his position short. Ultimately, what did you make of this?
Look, I think the remaining traders have been quite tactical. It's a short-term competition. Rahul's obviously had to adjust his strategy to account for that. Also, we're coming to the end of the competition. It was quite unusual. We saw a lot of volatility at the very beginning, what with Brexit and the fallout therein. And, it's still the summer. So other than that bout of volatility at the beginning, we've seen the traders readjust their strategies for the lower volatility environment we've had the last few weeks. So I think that's explained by why we've actually seen some of the performance level out. So I mean, I don't necessarily see any further fireworks for the next week and a half. And I think it'll be a very tight battle between the top 3 who are all very close in performance terms. Glenn
is very interesting. He managed to close the gap with the top leaders, but at the same time, his drawdown is quite high, almost 50%. Is that going to cost him in the final sprint? And after all, this is a big week. We've got the Fed, we've got European bank stress test, and we have the BOJ as well.
If I was a betting man, I wouldn't necessarily bet on his strategy. As you mentioned, he managed to catch up, but the volatility spike we've seen has been intense, quite different from, I've commented in the past on Richard. I thought was very impressive given the return relative to the drawdown. So the risk-adjusted return has been quite consistent throughout the competition.
I think he's also kind of right there. It does get that much more strategic because you kind of know you kind of have to swing for the fences or not, especially if you feel that you're lagging for whatever reason. But for me, it's still a little bit too close to call. But there's no doubt about it. A big drawdown when no one else has necessarily had as big as a drawdown as you have is not a plus, but maybe it'll give him incentive to take things to higher levels.
And Boon Sang, he's interesting because he's more cautious. He likes to play with a lot of options on the HSCEI as well as the A50. But we're at a time where China is not really seeing that much volatility as well. So ultimately, is this a strategy that is going to pay off?
I call him the engineer because if I recall correctly, that's what he started in initially. I mean, it's hard to know, right? It's really, really hard to know. Like, in a week such as this where we're taping, we have FOMC within 24 hours and the BOJ. You can make a killing on that. We had clients who made 50% on the Brexit day, right?
Wow.
So on the entire portfolio, not on one position, right?
Wow, that is amazing.
So, I think it still goes to show, especially when it's a very near-term game such as this, very tactical, things could change very, very quickly.
Very quickly. Yep. What kind of advice would you give to our top 4? We're about to unveil them very shortly.
Yeah, I'd probably say don't lose sight of your focus in the last couple of weeks of the competition. And, Boon aside, maybe don't swing too hard for those fences.
Okay.
I mean, I can't really add much to that. Their talents got them this far.
Right.
And they should just keep on playing their game. And good luck to all of them.
All right. And let's reveal the winner of the week plus our top 4.
The winner is... He's done it again! Unbelievable!
Unfortunately, we've had to say goodbye to Guo Chao of China and Alvin Jufitrik of Indonesia.
All right, there you have it. Top 4 who will be taking part in the grand finale next week. And remember to vote for your favorite trading talent and walk away with big prizes. Log on to tradingtalents.saxo. And coming up, we delve into the prospects for the European stress tests on Friday. Will they help or hurt the banking sector in Europe? We'll talk more with Kay and Richard in just a bit.
It's a big week for Italian banks ahead of the release of European stress test results on Friday. Despite Italian government rejections about systemic risks posed by local banks and the idea of a bail-in, shares of Monte dei Paschi have been under further distress, reflecting investor angst over the scale of the Tuscan lenders' capital shortfall. Italian banks have been under fire for their low profitability and non-performing loans that make up about 1/5 of the country's GDP, or about 360 billion euros. Analysts say that Italian banks on the whole may need a lifeline of about 45 billion euros, a sum that could be too huge to raise from investors.
Credit Suisse says a quarter of European lenders will not meet the minimum capital requirements in an adverse scenario. Well, it's not just the Italian banks we're talking about, also German banks such as Commerzbank and Deutsche Bank. Let's talk more with Kay Van Peterson, global macro strategist of Saxo Bank Group, and Richard Yetsenga. All right, so is this going to be a systemic risk? Over in the U.S., stressed banks actually ended up providing them some much-needed confidence. Dividends came along, share buybacks. What about Europe?
I think, from my perspective is when you actually go through a crisis, I think a lot of these results become meaningless, right? Because what tends to happen is if people lose faith in the bank, then it doesn't really matter how well you did on the stress kind of cards in essence. I think when you look at kind of a big picture perspective, I think probably I'd favor UK banks than, let's say, European Eurozone type banks, because I think there's still a lot of issues there.
Is it because UK banks are actually now sheltered from Basel rules, which will probably target even traditional lending?
I think it's a combination of that, and I think it's also a combination of what we were discussing kind of before, where the UK would be a lot more flexible to respond to a crisis, whereas if you're like, let's say in Italy, you've been seeing the issues they've been having trying to address the problems their banks have.
Yeah, I mean, we hear that there seems to be a supposed private sector deal, and yet the banks just keep on, selling on. What does that really tell you? Again, does this boil down to just an issue contained to Italy, as what Goldman Sachs says, or is it going to actually spell contagion?
Look, Europe has a slow growth problem, but it's a chronic problem rather than an acute problem, I think. So in that sense, you're not seeing capital flight, even with the share prices trading off. There's still a lot of domestic support for the banks from depositors, and that means that, we're worried about flow-ons back into economic growth, the credit creation mechanism, what it means in terms of excess demand for bonds, for instance. But I don't think we're worried particularly about a crisis being kind of a high probability scenario.
What about the fact that the sell-off, the epicenter of the sell-off is no longer restricted to Italy, it's affecting Germany as well? Some of the big ones like Commerzbank, Deutsche Bank selling just at a fraction of its book value. Does that offer you value? Or is this something to stay away? Because the latest worry is that for Deutsche, there might be a bail-in for its CoCos or even a state-backed rights issue.
I mean, absolutely. I mean, I think it's a little bit spurious to say they're cheap. They're cheap for a reason, right? I mean, 9 times out of 10, things are cheap for a reason. It's a question of, do you know what the reason is? So I think, how can you have, some kind of crisis on the peripherals when we all know at the end of the day, when push comes to shove, it's going to be Germany that's going to have to be bailing out, i.e. the core, right? So they're all interrelated. So it makes sense to me that there would be issues on both sides.
If there are issues, again, does this become just a European issue that keeps on stumbling along, or do we have another acute point?
Look, I don't think we have an acute point. I mean, it may look like we get close. I think policymakers, though, are so attuned to problems in their banking systems and what they can mean that they're tending to head them off reasonably early. I mean, if these chronic issues in European banks persist, you get continued kind of bull flattening in global yield curves at yield levels which look on any historical measure to be unsustainable. Of course, that's having impacts on banking systems around the world, because every banking system is finding it difficult to make returns and respond to incentives when their yield curves are very flat and very, very low.
So Stocks Europe Banking Index, that's trading at about a 2-decade low. What do you do? What kind of action would you take once the stress test results are out of the way?
Well, you know, for me, if you have to be in the finance sector, I don't know why you'd have to go in there, because I think it's just too hard, right? Unless you have a kind of a structural short bias. But if you have to play in it for whatever reason, it's a benchmark or it's your mandate, then maybe you'd want to be long US and perhaps selective emerging market banks or financial sectors versus short the Eurozone sectors.
What kind of advice would you give to investors right now?
Look, I think emerging market financial sectors have handled the stresses of the last couple of years in pretty good shape, actually. You know, the BIS, for instance, continues to write about excess leverage in emerging markets, and maybe one day it will prove to be excess. But at the moment, I think they've come through the export stresses, the China slowdown stresses, the Fed rate hike stresses of the last couple of years in reasonable shape.
Right, the changing world of the banking sector. Guys, thank you so much for your insights there. And we're going to take a look at our question of the week.
Before we go, here is our question of the week. Does the latest fall in energy prices spell another major retreat? Tweet me at Chloe Cho TV or email us at investorinsights@mediacorp.com.sg.
All right, Richard Yetsenga of ANZ and Kay Van Peterson of Saxo Bank Group, thank you so much for your insights today. And that is it for our show for this week. Remember to tune in next week. We've got the grand finale of Trading Talents Asia Pacific. We've got top 4. Who is going to be crowned the region's top trading talent? Stay tuned. I'm Chloe Cho signing off on behalf of the entire team. Thanks for watching.